Good morning to one and all. So this is Dr. P. Lavanya, working as Associate Professor in MBA Department of IARE. Today's class, we want to see regarding what is cost and the different types of cost concept which plays an important role in the managerial economics. So in the economical concept, whatever we do, we see what is production, what type of ingredients or the factors are there in the production. So when we want to go for any organization production, we always organization aim is to get profits. So why an organization, business, enterprise is started? To earn some amount of profits. Once when you want to see the profit, the first point comes across here is what is cost. Only we'll get profit when we have been identified the cost of the product. Once the cost of the product is identified, then we can say what is the profit of the production. So that's why first we should identify what is cost. So normally we'll say cost means expense. Normally the people used to say what is the cost of it, what is an expense of that product. So if a firm want to maximize its profits, or maybe it want to collect more amount of revenue by the business firms, so the organization must and should identify that what is the cost of the product. So the revenue matters, that is to earn some sort of revenue where it includes the cost. Means when I want to earn some amount of the profit, first I should know what is the revenue cost, then only I will see that what is the revenue. For example, the total cost of the product is 8 rupees. Cost is 8. Next, then I want to sell that product maybe for 10 rupees. So when I want to sell that product 10 rupees, then if the cost I know that is 8 rupees, then we can say what is the profit here? 2 rupees is the profit. That is the revenue generation. So a firm want to produce the goods and services in the organization, or business firms want to get profits only when they have been identified the cost of a product. So we can say like other words like cost means what is the outflow of any business. Means we'll start a business or we'll start to produce any sort of goods, only that what amount we are keeping in order to produce that one, or in order to start that business or a commodity we'll call like cost. So a product has incurred different types of cost, where we can't say that only one is the cost, expense is the cost. In cost, in accounting concept and managerial importance, means every organization profitization, organization 100% is there only to earn profits. That is profit maximization, the first and utmost objective. So for that, organization should identify what type of cost are there, and at the same way how that cost was affecting the factors of production or decision making of the organization. So in order to know that, first we'll see the cost means, or any organization where in the production of goods and services we have the factors of production. Already we know like various factors of the production like land, labor, capital and entrepreneurship. So when these factors, each and every factor, so production means we require land, we require labor, I want a capital, and we want to have some entrepreneurship. So these are each and every factor, whatever we have in the production must and should be awarded with some sort of cost, means compensated. We should pay for them. That payment or contributing each factor's compensation in the process of production we'll call like cost. And this compensation to each and every factor is known as cost, or the expenses or the amount what we pay to the labor or the land in the form of rent, labor in the form of wages, capital in the form of interest, or maybe entrepreneurship in the form of profits. So whatever the way we are awarding them, that one we should identify as cost. So normally we can say the cost means like expense also. What expense we are paying for each and every factor of production, or each and every process of production activity, we can call like cost. So in the managerial economics or economical activities, so it's related with the business and business decisions. So once when I want to identify what are the different types of cost which are involved in production process or maybe in any entrepreneurship, then automatically we can have the purpose of utilizing or maybe the method of taking that cost into the account. So first we'll see what are the different types of cost which are used in the managerial economics or in any enterprise, and what is their important or the advantages and their role played in the organization. So first we'll see there are the different types of cost we can identify, like direct cost, which we'll call like explicit cost, indirect or implicit cost, and the next one we can say like fixed cost, variable cost, accounting cost, total cost, average cost, marginal cost, and opportunity cost. These are the maximum or very much important. Maybe some other or there, maybe they will have some role, but an effective role played in an organization in the process of production and distribution of the goods and services maximum relate to these types of cost. So we'll see each and every cost separately. Like the first one we can say it is a direct cost or explicit cost. So direct or explicit cost means the cost which we meet through cash, means maximum we provide the employees or the factors of the production giving in the form of cash. So that type of cost means directly. So directly I give in the form of money or the bank check or anything which is given in the form of splitting means itself will be given at that time, that we'll call it as direct or explicit cost. So their producers actually pay this cost maybe in the process of production of goods and services. So like what we used in the production of goods and services means the cost which we pay to the materials, labor or other types of overheads or the expenses. Maybe like we'll call factory expenses, distributive expenses, management expenses, administrative expenses related to the production of the goods or maybe the distribution of that goods. And these costs may be accurate and easily traceable. Means as I'm saying that these are provided in the cash, then automatically accurately I say I pay 500 rupees or 1000 rupees, and they are easily traceable. Why? Because cash transactions we can identify. This cost could be easily traceable. So we'll see that what is the definitions we have in case of explicit cost or the direct cost. So an explicit cost is a direct expenses that is paid in the money to others or maybe creditors during the production of goods. Means here we can see that the regular process of production where we pay directly to the any factors of the production or to the any creditor, the person where we has to pay this direct expenses, we'll call it like explicit cost. So there are the some uses of these explicit cost, that these explicit cost or the expenditure which was increased mainly related to the cost of production, that is when the goods, services, commodities are produced. Means we can say like these explicit costs are production costs, means which are used in the production, maybe given for labor, materials or maybe for any factors of the production in the process of forming. So this is incurred maybe for in the production process which give consideration for pricing strategies. Why means indirect expenses are apportioned or maybe distributed, but direct expenses are very much required for knowing the price of a product. So 100% we consider a product price by identifying the factors, cost for the factors of production. So that's why the pricing strategies means when I want to go implement different types of pricing strategies, first I'll consider or give importance to this cost of production or explicit or direct cost. And another advantage of this explicit or the direct cost is that it helps in calculating the profits. Means as we know directly what is the cost. Maybe the material cost is 2 rupees, labor cost is 2 rupees, and maybe we can say like material 2 rupees, labor 2 rupees, maybe other overheads 1 rupee. So the total cost of the production is 5 rupees. Then I can say, so at what rate you want to sell? Maybe I want to sell at 10 rupees plus profit 5 rupees. Then I'll sell the product at 10 rupees. So the calculation process in case of having these direct expenses, it's very easy and also simple to give the price, and it is very much essential in order to take the management decisions. So in managerial economics, we want to see the manager's aspect of enhancing the organization in case of decreasing the cost and increasing the profits. So once when I want to increase the profits, then I should identify that which cost is less. So direct cost will help us to identify them directly. So last time material price is 5 rupees. Now it came at 4 rupees 50 paisa. Then automatically they can know that yeah, 50 rupees is excess gain for us. So in this way, in order to take any sort of a decision relating to the factors of production, these explicit cost or direct cost is very much important. So this is one type of cost in managerial decision making. And the second one comes under like we can say like indirect cost or implied cost. Implicit cost means where it is we'll call like a sacrifice or alternative cost, or maybe the opportunity cost of a factors of a firm. So we can see opportunity cost means sacrifice or the alternative, the next best alternative, whatever we have, that we'll call it like the implicit or indirect cost. So these costs we'll call like this implicit cost having another name like inputted cost. Means where the cash flows doesn't happen. Sometimes we'll say that I paid but I unable to show in the cash flows. These inputted cost like interest to capital, or sometimes for our own premises we'll give like a rent to our own premises or own house. So but in the accountancy or organization form, the premises will be paid rent, but just in the format of showing we'll say that is happened, but actually cash flows will not be taken into happen. So these implicit cost is also factors of the production which is sacrificed by the producer for alternative factors of production. Means it is very much essential when I want to identify if this is not possible, then what I have, what is the next one is there where I can get. So maybe 5,000 I am getting a room for rent, so unable to pay, then where? So for 4,000 where is the next best alternative? So sometimes these are indirect cost or implicit or inputted cost which help the organization to find the next best possibilities in the factors or in the process of production. So the important use of these implicit cost or it will help in decision making. What I said is alternatives. When I want to go for what is the next best alternative, or if I don't have this opportunity, what is available? Maybe in the labor. So if I am getting the labor is costly, so where I can find the cheapest labor. Maybe material, of this material is this price, where I may get a cheapest material. So the alternative we are able to identify, which is very much essential in the decision making. And at the same way, this indirect cost will also happens in ascertaining the opportunity cost. Opportunity cost means, maybe for example, all will think the capital or water. For example, we have self capital means internal savings. That is, internal savings in the organization will be taken within the capital. So when I want to start any organization, I'll have some savings first. By looking those savings, I'll go for alternative capital. So whatever I have savings in my bank, is that will get any sort of interest? It's my own money. Who will ask the interest? Owner's own money. They says that yes, it is my own money. I am starting the business. For me, I'll pay the interest. Yes, in the business, it is essential. 100%. The accounting gap principle says that each and every factor to be awarded. Maybe it's our own money, what we'll call as retained earnings. In the business, the money what we supply, the internal profits we have keep together, and we'll supply for the different uses in the organizations, what we'll call as internal earnings. So for these internal earning also, we see what is the next best cost. Means for example, if that internal earnings are invested in shares, what interest I'll get? If that earnings are invested in bank, what rate of return I'll get? That the rate of return I'll award for these internal earnings. That is, this explicit cost will help us to ascertain the opportunities first, different factors where a perfect awarding measurement is not there. And these implicit costs will have a direct impact upon the profitability of the organization. Seeing that differentiation, the direct cost we have no directly, but indirect cost expenses has to be identified and that to be taken in the organization, which have a part in the profits of the organization. So the next cost we can say like fixed cost. Fixed costs are those costs which cannot be changed in the short period. Means they are fixed for a certain period of time or certain amount. For example, simply we can say rent. Maybe when I have given rent for 1 month, for 30 days, the rent will be fixed. I can't change for 10 days, 1 week or few days. Maybe if I have been taken any lease, maybe for 1 year lease or 5 years lease, 5 years the amount will be fixed. Means where it cannot be changed in a short period of time. So it was given for a long period, or it will be fixed for all amount of production. Means for all the goods that cost will be fixed. Maybe irrespective of the production mechanism. Maybe you stay, one person stay in a one room, maybe will pay 5,000 rent. Maybe 2 or 3 also the same 5,000 we has to pay. That is, the amount will be fixed for a particular thing, that we'll call it as a fixed cost. So this cost was incurred by irrespective of production or irrespective of the utilized. Maybe it is not at all considered relating to the production, or each product will not enhance. Means as it is not as a direct cost, we can consider it is like an indirect cost for the production. So the fixed cost can be defined as the cost that remains same and fixed, maybe irrespective of the production of goods and services. Maybe for 10 goods, the cost will not be changed. Maybe for 5 goods, the cost will not be changed. Fixed for certain period, certain amount of production, the cost will be fixed. That is called as fixed cost. So some of the uses of this fixed cost is, the main and important use of the fixed cost is, it was evaluated in BEP, that is break-even analysis, which means the analysis which is used to find out no profit and no loss point. No loss point means when any goods and services are produced, so at what point of production we are able to get back my investment. For example, the cost of a product is 100 rupees. I invested 1 lakh. So if 10,000 goods are produced or sold in the market, I am getting my investment of 1 lakh. That is no profit and no loss point. Means where the original investment is rebacked, that point of production or selling, we'll call it like break even. So by in this break even, where we have the fixed and variable cost, and it is very much important to take the decisions relating to the break even point. And this also helps us in pricing strategies, where we can identify that what type of price we should be followed. When the fixed cost is based upon the amount of the fixed cost paying for a certain period, then we can go for utilizing the pricing strategies. And by knowing these break even or pricing, that is an important thing in the decision making of the organization. Once when we know the fixed cost, we are able to control other variable cost. Maybe every organization will have some limit where there should not be cost relating to cost. Means, for example, I want to produce a product, the cost must and should be within 10 rupees, or the cost should not cost within 15 rupees. Means, while estimating the production cost, we'll keep some target. So that target should not be crossed. So this fixed cost help us to control the other types of costs in the organization. And another important cost after fixed is variable. So variable cost means it will varies according to the production. So this may be changes. Means if you produce one product, the cost is this. If you produce two products, the cost will be changed. Irrespective of short run, means period, maybe short run or the long run, the cost will be differ. So this will be depends only upon the production, based upon the production. If that is number of units produced per unit cost, we can say like for individual unit or individual goods, what is the cost we are paying, that cost we used to say like variable cost. It is always changing. So that cost including during the production process, where we can say like labor, that is an important variable cost. If one labor comes, I'll pay 500. If two comes, 1000. 4 comes, 2000. Means changes according to the utilization of the factor of production. So this will be differ. It is not at all fixed for the production, maybe for short or long. So the definition which we comes under these variable cost was it is the expenditure incurred on the production of goods for ever changing. Means changes unit to unit or goods to goods. Means if you have one, the cost is this. Two, another is added. Means for every factor of production, the cost will be changed. Means changing according to the needs per unit. When the cost was changed, we'll call it as a variable cost. So the important utilization or advantages of this variable cost is along the how importance we give for the fixed cost. The second part means the price consisting of fixed plus variable cost. So it is also help in setting the price of the commodity, and this variable cost importance is it helps in planning of profits. Means future profits. How many units produced? What type of cost happens? If I increase the production, what is the cost of variable? Gives directly the profit motive. So how many units? 10 units produced. What is variable cost? Automatically I can get the amount of profit. Means in order to plan the future profits, this variable cost is very much helpful, where the organization is able to take the decisions. And this variable cost also helps in controlling the total cost of the organization, where we can identify that maybe labor cost, it was more. Once it was more, then in the total cost, what is more? Labor is paying more amount, material is less, and other things are less. But labor has more. Then I am able to control. So see that where we are getting the cheapest labor. So variable cost, per unit cost, and individually we can identify the cost of the factor where it will help us to control the different cost in the production process. So this is some of the importance which we comes across this variable cost. And another important item of the cost concept was accounting cost. So accounting cost or that cost of the firms which are actually incurred, means what are the cost we record in the accounting process. So in the accounting process, the main statements whatever we prepare was trading, profit and loss account, and a balance sheet. So the important statements what we prepare here, or what are the costs which we consider in these accounting format actually incurred, that we'll call like a direct cost, which are like explicit cost, accounting cost, explicit cost, or direct cost, or actual cost. So one and the same, where this was very much kept in order to have the future references. So here this accounting cost could be defined as the actual expenditure incurred by the producer in the course of the business, means direct cost what we incurred. But in the accounting cost, all these direct cost will have a perfect record. What I said, that accounting will prepare maybe in the trading, profit and loss, or the balance sheet, means where we record those transactions in the regular course of business, where we can see in the accounting process. So these type of cost we'll consider in the accounting cost. So the managerial use of these accounting cost, where we are able to identify that expenditure. So the total expenditure in the production, what happened last time I produced, what is labor cost, what is material cost, what is each factor of production, or other cost, marketing cost, where it are helpful to identify the expenditure incurred for each and every product, which is helpful in case of pricing strategies or want to take decisions in case of pricings. And these accounting costs, or the main aim of accounting statement is to identify the profit or loss of a organization for certain period. So these accounting costs are mainly utilized for calculation of the profits. And this will also help in taking decisions relating to the pricing, calculating profits, and want to identify these accounting costs we will call like post-mortem cost, means a past cost already happened. So based upon that, we are able to take the decision in the future expenditure of the productions. So these are some of the advantages of accounting cost. And the next cost comes as economic cost. So economic cost, that is the enterprise incurring the cost for economic activities, means business activities, in order to enhance the business activities or providing facilities where the entrepreneur will provide to the labor, workers, and all other. Maybe in order to do our business in a most promoted way or explicited way, means where the entrepreneur will directly or indirectly will do some activities which will provide or use goodwill for the organization. So that type of cost, we'll call it like economic cost. So these costs we can summarize like explicit, means direct cost, and also the implicit, means economic cost involves both the direct and indirect cost. So the definition of this economic cost, it is the cost where it combining or combination of both direct and indirect ones which incurred by the firm in the course of producing a commodity. Means here I am not distinguishing what type of cost. Maybe it comes under explicit cost or maybe comes under the implicit cost. Both clubbingly we will say the total cost, which we'll call like economic cost. So the main utilization or uses of economic cost is it is very much utilized when we want to price or going for the different types of pricing strategies of an organization, and when I want to know or calculate is organization is achieving profits or not, or maybe what sort of profits, maybe normal profits, supernormal profits, or maybe we are getting loss. So this type of calculations, for that purpose we can see the economic cost. No need for getting direct cost, indirect cost. Total was clubbed, so by looking at one we can identify or calculate the profits, helps in management to take the decision, and it will have a direct impact of the firm where we can differentiate the accounting cost and economic cost. Means where we can identify where directly, so the profitability of an organization where we can directly identify. So these are the some of the advantages which will comes under the economic cost. And the next category comes under the total cost. So the total cost or the total expenditure in order to produce any sort of goods and services, we'll call it as a total cost. In the total cost we can say like total fixed plus variable cost. Already we have seen fixed cost, it is fixed for certain production. Variable per unit cost, or it will change according to per unit. When these two are added, then we are getting able to get the total cost. Once this total cost comes, so that cost into units produced, we'll get the total cost of production. How much we introduced or we kept in the business, we are able to identify. It means what sort of amount I involved in the total course of production, we can identify by knowing this total cost. So where these total cost consisting of total fixed cost and also the total variable cost. So the definition of this total cost we can say like it is incurred by the producer to produce a particular quantity of a commodity. Means a amount, what amount of the goods we want to produce, we can identify with the help of what cost we have incurred for the total goods and services produced. So some of the advantages of this total cost is it helps in economies of the scale as a producer needs or want to produce. Already we have seen economies of scales. So economies of scales means when I increased large scale production, what sort of advantages I am getting, we can identify by knowing what is the total fixed cost and total variable cost. Clubbingly identified what is total cost. Maybe 8 rupees is the total cost. So when I increase the production, then what sort of price will be decreased by enhancing the advantage? Maybe the managerial economics or maybe material economics, whatever, some sort of advantages added. What amount of the profit or advantages we are getting, we are able to identify the scale of production or economies of production with the help of this total cost. So with this we are able to identify our pricing policies. What policy does the management want to introduce or to involve? So that type of pricing policy we are able to identify only when we know about the total cost. Once the total cost is identified, then I say that pricing low cost strategy or maybe high cost, penetration cost means we should be deep rooted in the market. So this type of pricing policies, whatever they want to take, that management decisions relating to that, we can identify with the help of this total cost. And the next category of the cost under this cost concept was average cost. Average. So what is an average production? So average, how many units you produced? 1000 units. What is cost you have? Maybe 1 lakh rupees. So 100 is the average. Per an hour, averagely, how much you will produce. So this is the expenditure what we involve for production of an per unit, or it is called a unit of a product. So here the average cost is also, we can say like summarizing a fixed and variable cost. So where we can say these average cost like total quantity goods produced. So the average cost is equal to average fixed cost by average variable cost divided by the total quantity, means average fixed cost plus average variable cost divided by quantity or cost of quantity produced. Then we used to get the average cost of the production. So the definitions what we are getting is average cost is expenses incurred by the producers to produce one unit out of total cost. For total I kept 1 lakh. For unit cost what is happen? Average how much you are getting? Maybe 10 rupees is in a per unit cost. So this type of finding out unit cost of production, we can call it like an average cost. So by knowing per unit cost, the main advantage of this average cost is where we are able to cut down the excess expenditure. Maybe the incurring cost is 5 rupees only, but I am paying 7 rupees, where unnecessary or waste to be eliminated. So this type of precaution we can take only when we are able to identify the average cost. So with this unit cost calculation, we can cut down the excessive expenditure, and this cutting of excessive expenditure will helps in optimum, means a perfect utilization of the resources, maybe land, labor, capital, where the resources are very effectively utilized. Once resources are effectively utilized, we are able to get more amount of the goods and services with a lesser cost. And along with this advantage, this average cost will also help us an important role in identifying the pricing strategies of the organization. And the next cost, what we have in the sequence like marginal costing. So this marginal costing is we'll call simple marginal, means additional cost or additional unit of cost which was utilized or made in other unit of production, means additional cost for additional unit produced, means 1 unit 10 rupees. If you go for 2 units, what is the cost? 20 rupees. Means additional expenditure involved by producing an additional commodity. So this what we incurred in the production process is known as marginal costing. So this marginal cost, where we can say that marginal cost of a production TCN minus 1, means which is defining like it is cost or expenses incurred for producing an additional or extra unit of a commodity. Means when I want to know per unit cost or individual cost of a variable one like land, labor or other things, where we can say that additional unit involved in additional manufacture. For 10 units, 5 rupees. Next, 20 units, that is 10 rupees. So easily we can able to identify. So the important use or importance of this marginal cost is helps in decision making. So marginal costing is one of the important tool and technique of management decision making in order to know profit planning, in order to identify the cost, in order to take make or buy decisions. So important decisions relating to the production process, utilization of capacity, new product manufacturing. So like this, in case of taking in a different decisions, the marginal cost is very much helpful for the management. And it also helps us to determine the cost of each commodity, per unit cost of each commodity, labor, one labor cost, one labor of raw material cost for every each unit we are able to identified. And at the same way, this marginal cost will help us to identify the planning of profits. So future profits could be planned. How many units we are introducing? Additionally, if I introduced another 1,000 units, what is additional profit we are getting or additional cost involved? So this type of estimations could be able to identified in case of marginal costing. That's why this marginal costing is help us to identify in planning the profits of future. Maybe it is considered as an important tool and technique in management decision making. Another that is last but not least, another important one is opportunity cost. Already we have seen in the explicit cost is also known as opportunity cost. So it is a choice or the next best alternative of every factor of production. In economics, when we are going for goods production and services, every business want to identify the next thing or the next best alternative. Why? Because the economics itself, we know that resources are very limited. Yes, when the resources are limited, then we can't use them extensively. So we should identify the next one. When it completes, what is next? What type of resources we can get. So the opportunity cost which help us to evaluate as what are the next best alternatives or possibilities present for the organization. So in the economics, we can call it like a sacrificed cost or foregone production factors in the business for each and every alternatives. So we can say like the definition is it is the sacrificed cost of factors of production for an alternative option or factors of production. Means the next best alternative sacrificed or alternative option. So it is very much essential in optimum utilization. Once when my resources are exhausting or completing, then it is the organization duty to identify the next one to continue the production. So best utilization. So carefully without wastage. By identifying the opportunity, there is no opportunity to get the raw materials. Then I want to utilize whatever the raw materials I have and get a best course of production. So helps for the optimum utilization of resources. So helps in decision making and each every point of production. Only when I know the opportunities of the next level, I can take the decision. If what is next, I don't know about the future, I can't take present perfect decisions also. And this opportunity cost will also help us to control the cost in each and every factors of production. So we can conclude by these saying that there are 10 important cost or the different types of cost which are very much helpful for managerial decision making in each and every point, maybe in the course of production, distribution, or to attaining the different objectives of the organization like profit maximization, cost reduction, cost prevention, or servicing or satisfaction. So in each and every particular objectives, whatever we want to reach, the importance and the use of each and every types of cost to be identified. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.